Hi. Okay. Okay. So are we here already? Can you hear me? Can everyone hear me? If so, please type so in the chat. Can anyone hear me? Hi, Anthony. Can you hear me? Let me see. The chat should be. All right. Can you hear me now? Can you chat now? Fantastic. Great. All right. So welcome, everyone. Welcome to today's webinar. I want to give up a couple of minutes for those who are just trying to log in and to join us. I want to thank all of you for participating today. We're going to be having a pretty good session. I hope that you like it. I'll try to keep it under that 1 hour so we can, for those of you who are football fans, can go and enjoy the semifinal between Spain and France. I mean, do we have anyone? Let me ask. Are any of you fans of football? And because this starts at 2 o'clock. It starts at what I'm sorry, like my time, 2 o'clock. But if any one of you obviously want to watch that afterwards, let's just. No, we don't. We don't accept U.S. clients due to regulations. That's unfortunate, but due to regulations, we can't. No U.S. citizens, no Canadian citizens either. Let me just make sure that we have a pretty good view. Okay, let me see. Just a couple more minutes here and we'll get started. We'll get right on with it. Okay. Let's give a couple of more minutes to see if anyone else will join us. But as I'm staring at the markets right now, we seem to be doing a little bit of a pullback on the Nasdaq. It was expected after it did early in the morning, and it did rally at the open, looking to reach that new highs, all-time highs, new ones. So can this be sustained? Obviously, there are corrections, pullbacks, imminent on the markets when we don't have any catalyst to push it, even though we're going to be starting a new earnings season. But not until then, perhaps between now and then, the market will do a correction. 2% correction is really what we can anticipate to see in the markets. So let's see. Let's see what will happen. All right, look, let's just get with it. Okay. All right. So Today we're going to be seeing, having this webinar by Vantage at the Vantage Plus section. And it's called How Active Traders Approach and Track the Markets. Okay. I'm your host, Giovanni Betancourt. I hold a Series 3 license, futures commodities license with the US. I haven't updated it because I haven't dealt with any US clients, but I do have my Series 3 ID number, license number. But I deal mostly with European clients and Latin America clients. I'm also a candidate for CMT technical analysis title. And I have a pretty simple model, of pay forward model, which is I don't have any higher education, and I taught myself and experiences reading the books and taking the tests and just watching the markets. Really, that's what I've done. And so, but I was given an opportunity to learn about the market, and I'm paying that forward. You know, that's my model. All right. So, advantage disclaimer, real quick. The information, context, opinions which are expressed in the presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Vantage does not guarantee the accuracy or reliability of the information provided herein. Right, so what's in the agenda for today? We're going to be looking at identify clear, consistent trading habits, learn to trade by determining momentum, ability to emphasize risk management, how to use strategies and indicators, and we're going to be looking at 3 bullish, bearish trading patterns at the end, and we have some Q&A. About Vantage. Well, Vantage is an Australian broker, multi-asset broker. It's been since 2014. We've won several international awards, International Business Magazine, Best CFD Brokers, and other things. We have over 1,000 instruments to trade, over 100 chart patterns and technical indicators, drawing tools on the forex markets and indices, shares from CFDs, commodity CFDs, and crypto CFDs. And what we stand for is lightning fast execution, intuitive tools, and I like to say that we are transparent and we do have the best interest of our clients at heart. All right, well, let's get right with it. So, to participate more actively in the market, it's important to know what kind of a trader you want to be and which metrics to follow. I'm going to be sharing some veteran traders' ideas with you. All right, so say you've been investing for a while, know the market relatively well, and feel ready to take the next step toward more trading activity, and and you're not thinking about making 10 trades per day. Perhaps you are, but turning more than the 5 or 10 per week you've been making. Now, this evolution is a major step and shouldn't be taken lightly, but for time's sake, let's just assume you've decided to trade CFDs on stocks and figure out how much of your portfolio you want to allocate to trading CFDs. Now, one thing that I do want to emphasize and begin to ponder upon you is that you should be comfortable with the prospect of losing money if the market goes against you. But that's not enough. You also need, obviously, to decide how you're going to follow the market so you can stay in a position of knowledge. That means developing a daily routine and having your tools ready before starting. You want to be able to decide what and how you want to trade. You want to have that already in your mind. You want to know what and how to trade and how you want to trade. You want to be able to have which metrics to be watching, So in the CFDs market, even though CFDs, and they've been around since, I believe, 1990s, in the UK started, and they were actually using them for hedging. Okay, that's what they were using CFDs for hedging. But in investing in trading, what you want to do, you want to be able to know what tools to consider. Okay, how to prepare for a typical session, building consistent trading habits. So with this metrics that you want to be following, you want to have already, your net profit, your risk reward, your maximum drawdown. You want to know those things. Basically, maximum drawdown, your risk tolerance. You want to know that beforehand because it's gonna help you know your psychology. And that's really, to me, after all of this time, that's the most important thing that you want to really control, and it's your own psychology. Your psychology, your brain is your number one enemy. So no textbook, really is gonna be able to teach you what to say exactly, what trading method might work best for you. There's no one right way to trade. You have different trading systems. You're gonna want to now using the AI boom, is algos, bots. So you gotta have a lot of tools at your availability, but you obviously want to be able to learn and to know how to use those tools. Some traders regularly follow a basket of around 10 stocks they already know well, or trade the forex market to hedge inflation of the currency, or trade, the energy market. Now, obviously, in all of this market, in all of these deals, you also want to be able to have a sense, you want to have a sense of how these small handfuls of stocks may trade around, earnings announcements, monitor the technical performance, and evaluate day-to-day how they're affected by over time. They get familiar with each stock's chart performance, and and can better detect meaningful pattern changes. So one thing that you obviously as time goes by, you also want to be able to identify those sharp patterns, because those sharp patterns, for a reason, they've been around for a long time. Right now, they haven't been around for 5-10 years. They've been around for I think like more than 20 years, if not more. So this pattern, your head and shoulders, your pennants, company hold, all of these things they come up, and they happen to be there because they follow, or they render a profit, or perhaps also help you, mitigate your risk. So some other people may choose to zero in on some other different type of performance, index performance, or certain sectors, focusing mainly on technical factors, spot trends, but also fundamentals. In our earnings season, news events, for example, take a look at a strong or weak company quarterly earnings report. It can hurt its shares, while a news event like a Federal Reserve rate hike can sometimes hurt the entire market. And talking about, will the Fed increment rates, cut rates in September. That's something obviously you want to be able to understand about that. I'm sorry about that. I just kind of cut off myself in there, but that's a big topic. Will the Fed cut rates in September, or will it hold it for November, or would they not cut at all? So, there's a lot of things that you want to be on top of. Sometimes, it can hurt the market, the entire market, if the Federal Reserve, actually comes in, hikes rates. So if Fed hike rates, then dollar index rises, because obviously everyone wants to invest in the dollar. So there are a lot of things that you want to keep in mind when it comes to obviously doing this. Now, perhaps what you may want to do sometimes is use a demo account, perhaps using the paper money virtual trading feature of the demo account with Vantage Markets to sharpen your skills risk-free before going full steam and using real money. But then try trading other sectors and methods, again, using paper money, and find out what you like to trade in which market or sectors you are also interest you. Now, advantage, we have a lot of resources for you. So you may also want to consider going back to school, not a brick and mortar one naturally, but consider Vantage Markets, and our online resources as a start. Attending class won't prevent you from losing money in trading, but everyone is going to have bad trades, but it can teach you strategies in general market behavior, as obviously you know this thing can help you out. It can help you create an investing plan, and that's really that you really want to have in there. You want to have your trade log, you want to have an investing plan, and taking a look at it in front of us, what you want to have. You want to evaluate your current financial standing. You want to obviously have funds that if you were to lose part or all of it, it will not change your lifestyle. That's something that you want to really, really stop and think about. Is the money that I'm putting into my trading account, if I happen to lose all of it, is it going to change my lifestyle? And the answer should be no. Okay, so you have to trade with risk capital, money that if you happen to lose all of it, it isn't going to take live under a bridge. That's something that you really need to ponder upon. Now, also define what you want to accomplish. Are you looking to mitigate inflation? Are you looking to build wealth? Are you looking just to earn an income? There's a lot of things that you want to think about, and then obviously determine how much risk you can take. Decide what type of investment to make. Are CFDs, is they trading the investment for you the right way to trade, or is it swing trading? Do you know the differences between day and swing trading? Day trading meaning that you open and close the trade during the same trading session, the same trading day. Swing trading means that you open the trade today and perhaps you will hold it for tomorrow, a couple of days, or even a week, or even a month. But that's more long term. But at least a couple of days. That's swing trading. Okay, so you also want to be able to establish your timeline. How long will it take? How long you're looking to earn all of this? And obviously, don't put such a short time frame because obviously you're gonna put pressure on you. But at the same given time, you also want to know when to enter and exit your trades and stick to a strategy outlined in your investing plan. One thing that you don't want to do, don't let the FOMO, fear of missing out, become a factor. If it's my money being put into the stock market, I want to do a high conviction trade. I want to scrutinize stocks that you believe are worthy of your capital, and be patient in terms of letting potential opportunities come to you. If you're waiting on a pullback, don't get impatient and say it's close enough, I'm in. Wait for the opportunities to come to you and consider technical analysis to help you confirm entry and exit points. You want to be able to do that. You want to be able to use technical analysis to help confirm those points regarding timing. If you miss a trade, there will always will be other opportunities down the road. It isn't the end of the day. Now, once you decide how you want to trade, develop a system to approach a typical day. Having a routine doesn't make you immune from losing money, but it can help prevent mistakes like chasing parts of the market you're not familiar with or trying to do too much at once. Again, not everyone follows the same routine, but some trading veterans recommended some of the following approaches. So one of those approaches is before the bell. What are you going to do before the bell? Before the bell rings. So one thing that I do and a lot of traders do, they just check the futures market. Okay, they trade the futures market. Markets never really stop trading, and even though we are trading CFD, it follows the futures market fluctuation. All right. So major futures or major U.S. stock indices, individual stocks and commodities and currencies trade most of the night. When you get up in the morning, one of the first things you may want to do is log into into your account to figure out where the market went while you slept. Plenty of useful online tutorials are available to get started. So see if futures are up or down, okay? And then check foreign markets and see where they are. Then check any economic data out before they open and see how it moves, move the futures market, because the futures market is going to be your guide. It's going to be the CFD's market is parallel to the futures market. Okay, so keep that in mind. Now, set up your screen. Besides coffee, one of the most important things things to help you start the day is having your screen ready with all the important benchmark. If there's a sudden market move, you don't want to be, you don't want to scramble and figure out why. I myself have up the major indices. I have the NASDAQ, the S&P, and the Dow. Now, in technical analysis, all four major indices, which is the Russell 2000 and included in that, should be in sync with the market fluctuation, meaning that if the market is on an uptrend, all four indices should be in the same direction. But it is not the case right now. Only the NASDAQ and the S&P are in an uptrend. And if you look at the Dow has been, in a CFD's chart, has been mostly flattish. Has been just doing more over lateral movement, just horizontal movement, more of a consolidation movement. It has had its up and downs, but you see, when you follow the futures market and you come into this CFDs, you'll receive that push or that volatility in your charts. So with the major moving averages, I have also gold futures, oil futures, the 10 years treasury note. I also have the most active stocks, 52-week highs and lows, and the biggest percentage gainers and losers also. Now, before the open, I also look at the calendar to see which economic data and earnings are scheduled to come out. That's something that you also want to be on top of, because you don't want to be, trading, looking to trade something, and then out of the blue, you have received all this volatility, and you're scratching your hair, you're wondering why. So you want to have finger to the wind. When you arrive at your desk, you want to have a sense of what the market is doing. Sense of what the type of market, sense of the previous day's activity. Review the charts of major indices to know what sort of a market you're in. If you are a player, or you like, if you're a football player, baseball player, or whatever, like a player entering the game, you need to know the score and what inning it is. When you first come in for the day, have a sense of what type of the market we're in. Are we in a bullish market, bearish, or sideways? So, and as you drill down, see if there's a correlation between what the overall market does and what your individual stock or basket of stocks do relative to the broader market. Okay, that's something very important to do, right? So, yes. Generally, a rising tide lifts all boats, and a falling tide can sink them. But relative strength or weakness to this tide over a given period of time can give you an indication of whether a security is under accumulation or is under distribution. So, and again, in other words, what story is the chart telling you? Does the price action suggest investors want to be in it? And then cross-reference the performance of that asset with the overall market to determine relative strength or weakness. You also want to be checking the calendar. Stay aware of the time of the year and its possible impact. While seasonality isn't the final word, it can play a role. Look, if it's late December, the market might be more prone to have a Santa Claus rally. And if you're not a U.S. investor, but if you do follow it, you understand that in December you get a tax break, if you obviously place a lot of trades into your reportings, and so that's why it's a lot of people following into that, so you can write it off in your income tax. But that's probably a good sign. So if you have a Santa Claus rally, that could be an opportunity for you to come in and ride that wave. Now, if it's early January, of course, people may be selling winners from the previous year, pushing stocks lower. And there is that old adage of selling May and go away, which it didn't come to fruition this year. So that's one thing. Now, during the session, during the trading session, watch key indicators once the bell rings. Look, consider following a handful of key metrics that will often set the tone. There are three things I look at constantly. They are the US dollar, because when the dollar is strong, foreign sales will convert into fewer dollars and thereby lower profits. And that often leads to falling stock prices and vice versa. Okay. Now, also, the yield on the 10-year US Treasury note. When the yield is low, it can boost up prices because the present value of future earnings is higher. Now, a higher yield can lead to lower stock valuations as the cost of capital increases, making equities less attractive compared to the risk-free return on government bonds. I mean, yes, risk-free. Now, also, crude oil. An increase in crude oil prices means that transport costs will increase, which in turn will increase the cost that the company has to bear. But not only for companies, all right, for importers, for all those countries that need to import, buy crude oil. So it's going to make it more cost for them. So again, this implies reduced profit margins and a decrease in stock prices. And conversely, falling oil prices will cause stock prices to increase, right? So when you're seeing this, you want to be able to have in your mind momentum. How are you going to determine momentum? How do you measure momentum? How are you able to see if this movement that you've seen in the market, in the stock or the asset that you're trading is consistent and it's going to hold? So this means watching the path of your stock either on charts or using momentum indicators such as the RSI, Relative Strength Index, Average Directional Index, Commodity Channel Index, the Bollinger Bands for a sense of direction. All of these metrics are easy to set up on your platform. You can even use the platform to create alerts on prices if a stock is early or not you want to watch. So those are things that you want to be able to look at. Now, look, I also tend to look at pivot points on individual stocks I'm trading. I look for stock assets gapping up or down. Now, if you had this information when the NASDAQ opened with that particular, this here right here, I'm showing you right here. Let me see if I could draw something here. Let me see, draw. Okay, so this right here. This gap up was created last month, okay? And that's when the market, just opened really like around 2,200, 250. Had you seen this and continue to move, be in the right side of the gap up, right now the market, the high today went to 20,000, almost 800. So that would have been almost a 600-point move that you would have already been in it early enough to make a profit. So that's something that you want to keep in mind, all right? So that's why I look at assets gapping up or down, and follow the news and chart as to why that happened. So okay. So also emphasize risk management. Look, some traders choose to only risk 1 to 2% of their capital for each trade. Again, this is all because it helps you with your psychology. We're humans, obviously, and when we have a ticket, we know that we're gonna have to pay, and we get pissed off ourselves because we didn't deserve that. We have not paid that ticket. But if you look at it from a percentage point of view, if you say, okay, that ticket is only 1% of my whole worth, then okay, it's not that much. So using that psychology, using percentages, is going to help you with psychology. So using 1 to 2% of your capital for each trade, by using this as a starting point and knowing your downside exit point, can help you mitigate and help you control your emotions. You want to be able to know when to enter. You want to know when to to get out. So this exit point, also known as your stop price, with the use of a stop loss. Use the stop loss. use stop loss. I know there's a lot of things out there and don't use a stop loss because they know where where your stop loss is placed, and they'll bring the market down there. What if the market went down there in one chart, and in another chart you see it going the other way? That's why I suggest, and that's why I say follow the futures market. If you trade in CFDs, which obviously you trade CFDs, you can follow the futures market on a Bloomberg terminal and see how they are parallel. So if you see in the futures market that the index is moving higher, but on yours is moving lower, then you're gonna scratch your head. Hey, why is this happening? And then you may want to reach out to your broker, to your account manager, and ask him, why is that happening? Again, it's just a different ways for you to follow and mitigate your risk. You want to watch the charts. Okay. Also, maybe you only trade based on fundamentals like earnings and central bank policy. Even then, you should learn basic charting and use it to follow the stocks and indices you monitor for most closely. Look, technical factors on the charts often determine direction, perhaps providing trading opportunities beyond the bare fundamentals picture. And you need to become familiar with technical analysis. Technical analysis, for most, is, let's say, it's a jargon, but it is there for a reason, okay? And it's been there for a long time. So if you come in fresh, then I'm looking for technical setups like a stock bouncing off a longer term moving average or a key support level or breaking above resistance. In front of us, we have, again, the NASDAQ, which on May 31st bounced off the 50-day moving average after it did it created a low. It was starting to do several days because it had 2 previous days trending lower. Yeah, let me finish this, and we'll comment on the Q&A. Okay. So again, doing this, following the charts, and if you have seen this movement on May 31st, then you would have already started even below where the market had moved towards 20,000 and above, because it started that move. It started May 31st when it bounced off that 50-day moving average. So open up your chart, go to the NASDAQ, okay, go to the daily chart, and go back to May 31st, put in a 50-day moving average, and see how that on that day, the market, on May 31st, the market, it fluctuated lower and it bounced off that moving average. It closed in the red still, but the next day it started a rally. And from that rally, we moved to where the gap it began. Okay, so you would have been in the profits. So let's basically the moving average, it was at 18,559 points. The gap happened right around 2,000 points, and we are today trading at 20,000. Right now, 20,657. So that's a great trade. So if you follow, okay, you follow your charts, your key level of support and resistance, have they broken above resistance with conviction, which means heavy volume. You also want to be able to follow those movements. If you see a movement to the upside with very little volume, that could be some trouble right there, okay? So you want to be able to follow those moves with volume, okay? Now, you'll only be able to make trades like that if you're closely following the charts. Look, fundamentals are, maybe good enough. But if you're simply an investor, but trading puts technical factors on your list, even if you're not wild about the idea of charting, prepare to get out. One key element is exiting a bad trade before it hurts you even more. Look, if my thesis for establishing a position proves to be false, it's time to cut bait and admit I was wrong. So be willing to admit you are wrong and do your best to minimize losses when a trade goes against you. Because as a trader, your first job is to maintain capital. So you want to minimize losses and let the winners run. If you focus more on controlling your losses, your profits will keep you happy. All right. So again, do your best to minimize losses when a trade goes against you. The emotional aspect of trading, fear, greed, is one of the biggest potential hurdles for traders. All your trades will provide valuable experience, but only if you're willing to learn from your mistakes and make appropriate adjustments. Practice is important. It's always recommended spending time paper trading and monitoring how you deal with losses before trying it for real. Look, as the session winds down, it's tempting to think of dinner and dinner plans or traffic, but don't get distracted because one thing is for sure. The last hour of the trading day is often the most volatile and can provide clues about where things might go the following trading day. Between 3 p.m. and 4 p.m. is when you get the real identity and direction of the market. If the market is jittery, okay, and sells off at the end of the day, that tells you something. Always watch the last hour of the trading day and the last hour of the trading week because, and I'm going to do a pause here. There's something also in technical analysis. You look at the last hour of the trading week, okay? The last hour of the trading week, the last day of Friday, all right? You look at that last hour and you set up your typical price range. And how you obtain your typical price range is you add when the market closes, all right? You grab the high, the low, the close, you add them up and divide it by 3. So that value, you're gonna be able to use it for next week or starting on Monday. So you already set up on that value on your chart with a line or with a horizontal line. And if that on that Friday, the last hour of the trading week, you saw that the market rallied and closed in the green, and you have your typical price. And then on Monday, you come in and you see that the market is also on a rally mode, is operating to the upside. Then you're gonna have an idea, or you're gonna say, okay, the momentum of the previous week is overflowing to this one, so we're gonna start looking for potential setups that are gonna be long setups, buying setups. Okay, so that's one way to look at it. Now, if the last hour of the weekly trading is positive and the rhetoric is positive all weekend, the chance of opening higher Monday is also pretty strong. So that's there for you after the bell. So it's still too early to shut your screen down when the closing bell rings. News often picks up. That's especially true during earnings season when many companies report after the close. So obviously, this is from Monday to Thursday because on Friday, hey, it comes in, market closing, that there's no after hours. Okay, so this is from Monday to Thursday. So again, during the earnings season, when many companies report after the close, you can't be an expert on all the stocks in the S&P 500 index. But when any company you follow closely is reporting, your afternoon could be busy, and stocks do continue to trade after the close of business on Wall Street. An after-hours market you still have access to. Liquidity, is less, and stocks tend to be more volatile after hours. But maybe I see something interesting because of news that broke or earnings release, and I want to be aware of it the following day. So traders generally like to go to where the action is because stocks in the news typically have the potential for a larger move one way or the other. And before you log off, it can also help you check market stats like daily volume and the number of stocks that advance versus the number that decline. This is an exercise that you can do. And like, I don't know, Jim, I think you're a US trader. The dot plot for the Fed, which is basically the advanced, the advance and decline numbers. So you add how many stocks advance versus the ones that decline. So if you have more stocks and the advance, then you per se you're saying that you're gonna have a momentum to the upside following in the next day. Okay, now that's the opposite is true. If you have a more declining stocks than advancing stocks, then you might be thinking, okay, perhaps the market is about to reverse, to do a retracement, a pullback. So those things you want to keep in mind, and you want to keep all these things in your mind because you want to keep your mind sharp, active, because it can get boring, just watching a chart. So that's another thing that you want to be able to do. So a market that rises sharply in low volume can indicate lack of widespread conviction in the rally. So that's why you want to be following the advanced decline ratio. Now, big volume days mean more than light volume days. And if major indexes fail but advances shares outpace decliners, it could indicate that just a few large names weaken while much of the market gain, giving you a different spin that now you might get from watching the major indices alone. For example, now, so we talk about the Magnificent Seven, and out of the Magnificent Seven, really, NVIDIA was the ones that the outshiner. Now, after the stock flip 10-1, it did retreat it, but now we saw Tesla having nine days in the up, in moving higher. Also, Apple also recovered, and Nvidia it happens to be finding its path. So again, look for this thing because rising volatility in a rising market can also be a sign that something needs to give. So keep an eye on the VIX, okay? The VIX, for those of you that does not know or doesn't understand what the VIX is the volatility index. And the VIX is simply used, or it was created by following the expiration date of the options on the S&P 500. So as the expiration date for those options on the S&P 500 came closer, then meaning there will be people coming out of those positions, therefore showing whether they are going to buy more put options or more call options. So if they bought more put options, that meant that they were hedging themselves against the market falling, because a put option protected you from a falling market. That's how you make money anyhow, from on a put option. You want the market to fall. So if people came in and bought more put options, then it was indication that there was fear coming into the market. So therefore, most likely the market will drop, will fall. The inverse is correct. So if more people came in and bought call options, they were anticipating that, the market is going to rise, so therefore they will be making money on those call options. So when the VIX, or when the options came to expiration, the VIX used an algorithm, a formula that calculated how many more new contracts were being put on, more puts or more calls, and that threw a number. So when you see a VIX that is low number in 14, like we are 14, somewhere around 14, 15, then that means that the stock market is rallying. When you see a VIX that is moving higher to the 20, 25, you're going to see the stock market dropping, okay? That's right. So this is when that happens. Now, again, keeping an eye on the VIX, because trading activity can be frantic and intense, and even if it's only a few trades or a week or month, that's why it should involve a real commitment to learning and practicing. They will prevent bad trades or possible loss of cash. Okay, but both could set you up for a higher chance of success. So now we're gonna start looking at those setups. Let me see if I could erase this. Shoots. Right. Isn't there anyhow? So trading three bearish trading patterns. Okay. These patterns, bearish trends can become a concern during a slower economy, which is not happening right now, but it's beginning to happen in a way. People might be saying, okay, so the Fed needs for the economy to slow so they can have a soft landing. So therefore, no more interest rate hikes and rate cuts can start into effect. So even so, looking at the market style, and since we are having all-time highs almost every single day, and the correction is about to happen, then we want to be able to see how we can come in and take some positions into the market. So again, a concern during a slower economy is where we can become more adamant to looking for reversal signals. So learning how to spot patterns and potentially profit from them, is a good idea, obviously. So stocks can tumble for all sorts of reasons, and earnings missings, soaring investor sentiment, world events, and these moves can play out over mere days or many months. Now, I'm going to share with you three ways technical traders can spot early signs of decline known as bearish patterns and potentially profit from them. The first one is an island top, okay? An island top. An island top, this is a reversal pattern, can mark the end of a lengthy uptrend, which is basically where we are right now in the indices, the Nasdaq and the S&P. So mark the end of a lengthy uptrend, and it is one of the shortest bear patterns, generally taking just 3 to 5 days to form. Now, this first indication about island top is a significant gap up, which in our case, and in front of us, that gap up happened to be right here. But I don't see. Let me see if I could put again the notation. Let me clear that out, clear the range. Okay, so here, that's the first gap up. Okay, that's the first indication of an island top. Okay, a significant gap up or sharply higher prices at the open, following an upward price trend. If after a few days of trading in a narrow range, okay, which is basically what we have in here, narrow range, okay, the stock experiences a commensurate gap down, which is basically this one right here, okay, creating a distinct peak or an island top, which is basically, let me erase all of this again so you can see, which is basically this is the island top, okay? This may mean that the uptrend has reversed, okay? And given the short time frame, island tops can be difficult to detect with certainty. Now, strong trading volume when the stock gaps down can act as a confirming signal. Again, strong trading volume when the stock gaps down. So in this case, is this part, this is the gap down, and look at the volume. Look at the volume that is created here. So that's what you want to see, a gap down with volume. If you see a gap down and very little volume, that is basically a continuation of the previous trend, of the previous move. Okay, so let's take a look at how we can trade an island top. Okay, so consider waiting until you see the corresponding gap down before opening a short position. Okay, which is basically number one. Okay, that's the short position. So we have consider waiting for this gap down to be created, okay, before opening a short position, and set a profit target near the last pullback before the island top emerge. So the first pullback is here because we've been moving higher, but the first pullback was here when the market moved higher and then it pulled back. Okay, it pulled back. It was created with what? A hammer, right? An inverted hammer in this case. Okay, so it was created, that particular pullback was created here. So that's where your target will be. You want to target, that's what you target, you want to, that's what you want to have your target. All right, now to protect yourself, right, you could open a buy stop order around the price where the stock finally gapped up. So right around where number 3 is. So around here, that's where you could probably come in. Or your 1% risk reward or 2% risk tolerance however that amount of dollars is, okay? And then translate it to how many lots or positions you're looking to trade. So that's how you can trade the island top. Now let's take a look at the next one, which is a bear flag. So a bear flag, this short-term bearish pattern occurs when a longer-term downtrend briefly rebounds. When a longer-term downtrend briefly rebounds. It can help determine whether the stock's descent is over or will continue. And it typically takes from 5 days to 3 weeks to form. Now, the first sign of a bear flag is the flagpole. All right, so here's the flagpole. Let me bring up against so here's a flagpole right here. This right here is the flagpole, okay? Because the market dropped, right? That's the first sign of a bear flag, the black flag, which develops from a swift decrease in price. And once the stock finds a near-term low, it will trade within a tight range for a period of days with the high and low trend lines forming the flag. Okay, now the shape of the flag, or the shape of which can be horizontal or an upward sloping. So, and also one thing that I like to also keep in mind, or also I like to look, is that the size of the pole. Let me just erase all of this here real quick. The size of the pole. You can take a look at the entire pole, okay? And when the market retraces or does it's an opposite movement, did it stay within that pole range? Okay, it started moving higher, but did it stay within that range? That's something important because you can do two things here. As you identify that the market has created a top or is the price looking to break again, you can use the width or the size, the height of the pole as your measurement for your profit. How much more the market will move lower. So again, if the price breaks below the flag's lower trend line, the stock is likely to resume its prior downtrend. So let's take a look how we're going to be able to trade this. How do we trade a bear flag? So again, consider waiting to enter your position until the price breaks below the lower trend line, which is point number 1 here. Okay. As for when to pull the plug on a bear flag trade, a good rule of thumb is to subtract the length of the flagpole from the breakdown price and set a profit limit order there. So that's why this is a flagpole, and this, which is basically that particular length, okay? So you could also opt to close out only half of your position when it hits your first stop and place a trailing stop that will allow you to further profit if the price moves lower. And finally, consider placing a protected stop order above the flag's lower trend line. So that'll be right here, okay? Or again, your 1%, 2%, or 2% risk, okay? The next one, let me see, I gotta close this. All right, the next one is a double top, okay? Now, a lot of people also kind of get confused with the head and shoulders because obviously the first top or the first shoulder, the first part of head and shoulders is a top, but the second one needs to be much higher than the previous one. So here is when you're gonna start, paying attention. Is the asset or the stock forming a head and shoulders, or is it going to be a double top? You'll know it's a double top because it didn't surpass the previous top, the previous movement to this upside. So that would be a double top. But that's just one way for you to identify. So this double top, this is a reverse pattern, and which indicates the end of a long-term uptrend and the beginning of a downtrend. And it's usually denoting a major shift in sentiment. So if you have a shift in sentiment which momentum indicators are you going to be using? The commodity index indicator is one of them, okay? Your RSI, your Bollinger Bands are also great for that. The RSI, are we in an overbought territory? Okay, or are we not in an overbought? How much of an overbought territory are we? Because in the Nasdaq, if you look at it, we are completely deep in the overbought territory. So is that sentiment over? No, it typically takes at least a month, or sometimes as much as a year to form. But obviously, that's in the futures market. But in the CFDs market, it's much faster. So, and sometimes as much as a year to form, it can be too raw to say. And the top is among the easiest patterns to identify. And a strong uptrend is followed by two distinct peaks at roughly the same price level with a trough in between. And now, if the price breaks below the trough, a downtrend may be in the beginning. Okay, so that's where you obviously want to be able to keep your eyes peeled when trading this one. Now, how do we trade a double top? So again, you want to consider waiting for the price to drop below the trough before opening a short position. So where is that? The trough is right here. So the market moved, it created a top, it retraced, it created, this is the trough, it rebound from here, it move again, meeting the previous high of that peak. So that's why it's a double top. All right. So here the market continued to move. So here is where you're gonna want to enter your market. Now, there's different ways to do this, and it's gonna depend on how aggressive you want to trade. If you're an aggressive trader, right, you may want to follow the market. The market made a top, it traded lower, it created a trough, it rebounds from here, and you've seen that with a green candle, it hit the top, or hit the high of the previous top, right? And the next candle is a red candle, and an engulfing red candle. So that candle engulfed that previous candle. So you could, for those aggressive traders, you could enter at the next opening of that red candle, so the second candle. So you first have your green candle, right? The next one is a red candle which engulfed the green candle, and then the next candle. So this is your first one, this is your second one, this is your third one. Your third candle, you enter to the downside, obviously enter selling. Those for the aggressive traders. If you are more conservative, then you're gonna obviously want to, to wait for the price to drop below the trough before opening your position. So as the stock might find support at that level. So if it breaks to the downside, which suggests further weakness, the odds are strong that the firmer uptrend is over. So to find your profit target, subtract the height of the tops from the breakdown price. So the tops breakdown price, okay, subtract that, and that's where you find your targets, okay? And you want to be able to settle a trailing stop, which can help you realize more profits should the stock continue to fall. Now, here is another way that you may want to do that. So you have a trailing stop, right? The market continues to move lower. You can move that trailing stop in different ways. Here's two ways. If you want to be a aggressive trader, every other two candles. So let's say, for example, the market is trading. Let me erase this. Hopefully you can see this. So the market is you enter the market right here, right? The market is moving lower. So as the market did a bounce here towards where you entered, but it continued to move lower, then, and you already trading right here in this candle, right? And the market is moving, you may want to count 1, 2 candles to move your stop loss to the top of a second candle. The market moved again, another candle down. Well, you count back 1, 2, and that's where you that way you play your trailing stop. If you want to be, let's say, okay, I want to be conservative but aggressive, then only one candle. So the market is, let's say, for example, for example, the market is here, right? Let me erase all of this. The market, you're in the market right here, okay, and you place you drag your stop loss, your take profit to this one candle behind. Market move down here, then you drag it down one candle behind. Market move down here, then you put it here. Market move here, then you put it here. Market move here, then you put it here. Market move here, then you put it here. So you see, so one candle behind where the market is. That's one way. All right. So that's about it. Besides that, I want to leave it with a word of caution. Downward moves happen much faster than upside moves, and they also reverse more quickly. So traders need to be nimble when trading bear markets. So for this reason, consider starting with smaller positions and setting firm price targets for closing those out, okay? Now, using trailing stop orders can also help prevent some reversals from eating into your profits or creating losses. Back to you, Jim, in repeating with that example regarding following the futures market to confirm the market's moving in the correct direction. So you are a CFD trader, right? And you have a position in the CFDs market. You trade in the NASDAQ, for example. Then you look at the futures market. How are you going to look at the futures market? You're going to have a futures account, or look at the Bloomberg terminal, or go to barchart.com, which is a futures market website. But you have to have real-time data, all right, so that you can follow both markets, the futures market, the CFDs market. Okay, so if you trade in the futures market, you are trading a particular contract that will expire in a particular day. The CFDs doesn't have expiration dates, but that's and for anyone else that matter. You could just do that. Trading the futures market, the comparison, the differences between trading the futures market and the CFDs market. In the futures market, you have to open an account in the US in the USA, okay? And to day trade, you're gonna have to have minimum $25,000 in that account so you can day trade, because that's a day trade pattern rule that they have. And to open a position, you're gonna have to see what margin the broker is using. Some may use 11%, 15%. And the difference between the CFDs is that you can change that margin or how much with $1,000 or $100. You could trade a crude oil contract just by lot sizes. So it is less. It is risk. It is about the same, risk, because obviously the market is what shows the risk, but you're exposing yourself less in the CFDs. You're having less value of dollar exposure than the futures market. All right. Does anybody have any questions? Are there any questions that are out there? Is anybody here? Anybody, any questions? Is everything clear for you guys? Okay. If not, then I'm gonna end the webinar. I want to thank you for watching, for joining me. And if you liked it, give a shout out. I'll be doing more of this type of webinars. Okay. Hopefully you found this you found it very useful. Apply what we've seen this. Again, follow. Look, guys, follow those three. Follow the US dollar index, follow the 10-year note, and follow crude oil. Why are we, first of all, remember, why is inflation so high? Because crude oil went to 140 when the Ukraine-Russia broke out. So it made everything more expensive. Therefore, the Fed have to start raising interest rates. Yes, and we came out of confinement of the COVID-19. But hey, follow those three. the dollar index moves, it's going to put pressure on the metals. It's going to put pressure on the currencies. Dollar index falls, you're going to see movement on the upside of metals and the currencies. Okay. Oh, nope. Sorry. No, no decision on that rate decision. Look, actually, I'll say this. No, this is my opinion. Canada was the first country to cut rates, and obviously the European Union followed. The states, the United States, to come in and follow may not happen. But obviously, that could probably happen. But again, it's all about the overall world economics, how the country per se, each country is doing. So that's that. Anyway, thank you for watching again, and I'll see you on our next episode. Thank you. Bye now.